An entrepreneur is hard. There's nothing easy about being an entrepreneur. It's even a difficult word to spell. Good luck. It comes to us from the French, which may explain its difficulty, and it means adventurer. And being an entrepreneur is...
Okay, so back to your question. I think, to your point, being an entrepreneur is hard, but at the same time, I think now is the best time to be an entrepreneur.
Why?
Because there's so much money around, and so many funds that have been raised, and so much money that wants to be put into amazing businesses or new businesses. And especially our category, I think health and wellness is, to me personally, but also to investors, it's a gigantic market. It's a multi-trillion-dollar industry. It's very fast-growing. The whole world moves towards health and wellness. So I think we all have a really, really good opportunity here. But being an entrepreneur is hard, yes. You will get slaps in your face basically on a daily basis. I sometimes say that I feel like Super Mario in that game where you run and all of a sudden there's a hole here and then you recover. There's a stone coming from the left side and another one from the right side. So you always have to figure it out, and you get no's and you get like problems to deal with like every day. And you have to be the one that always self-motivates yourself. There's nobody else that say, hey, come on, everything will be good. So I think having a strong personal vision and having this drive and the passion and the dream that keeps you up at night, and you really, really want that because you're truly passionate, really helps. And I think it's actually very important to have that being an entrepreneur.
Yeah. What do you guys, what do you think?
To me, it's like, it comes down, I really say 3 Ps. I've said it for 25 years. Passion, persistence, patience. I don't even like the thing of iteration, because as soon as to me, it's just a normal part of building a business. As soon as you finish the business plan, there's 7 things that have changed, and you just gotta be ready to roll with that, and expect that you're gonna wake up every day with, like you said, Constantine, no's or obstacles, and that's the beauty of, but if you're in a space like wellness that you love and you're passionate about, on your crappiest day, you're still, to me, are the people who like get up every day and go to work with something that they're not passionate about.
A lot of the same themes. I think Martin said it as well. I mean, we invest behind an idea, but it's also about that entrepreneur and who's running the show. And I would just say for the entrepreneurs out there, it's really their willingness to take advice. So we've gotten involved in situations where they want to take feedback. They're willing to pivot if it makes sense. And then people who are just singularly focused, even if some things are telling them to do, to pivot or to make another move, they're just singularly focused. So you have to be willing to accept the advice and when it makes sense.
Yeah, I mean, I'll just say, from a capital allocator standpoint, I don't want to shortchange what we do, but the founders are the ones that are really doing a lot of hard work. Yeah, we have to pick the right companies and structure the investment the right way, but the founders are the ones that are getting up every day and grinding and building great companies. And it's an honor to work with a lot of really innovative founders that are doing good and bringing better products to market.
Even really good companies that come to you, what you really look for at the end of the day is the jockey.
At this early stage, yeah. I mean, we typically, there's got to be we usually invest in brands that have 2 or 3 years of track record under their belt, and we can look back at kind of sales and how they grow. But, in the seed and Series A rounds, you're backing the founding team and your confidence in their ability to execute on their business plan.
And I'm just curious, people who are here today, are most of you early, looking for money early, or is it later stage? How many are early, Series A, seed, and then later stage? It's mostly early. So, I mean, I think that's a really good lesson too, that it's really on the shoulders of the jockey or jockeys and the team, not just the concept, because it's really who you're investing in.
Absolutely.
And so,
yeah, so I think the beauty of the time that we're living in now is that there's so much money, and we have the funds on the one hand side, which can add a lot of value, because many of you guys are also entrepreneurs and have done it before. But then I think if I start a new business now, I would think hard, do I actually really have to raise money? Because yes, there's like the big idols like the Airbnbs and the Snaps, Snaps and the Facebooks, but there are not too many out there? Or is it cool to just build a company that just makes 10 million of revenue and maybe you just make 2 million of profit and that's just for you? So I think there's a difference, and I think there's nothing bad with the second option. I think also another option, if I start a business now, is crowdfunding. I think that's the coolest thing to do, because if you can convince your customer to buy your product and they pay you, like there's crowdfunding campaigns that raise up to $20 million like pre-launch, you don't give up any equity. It's the cheapest money, you have customers, you have like a loyal fan base from start one. I think that's the coolest thing to do.
I would just one thing on that. My personal opinion is you don't want to raise money thinking about the next round. So I don't think there's infinite capital out there. I think you need, we look for good stewards of capital. So whether it's in the angel round, Series A, B, different places we've gotten involved, if you're raising money, we want to make sure that you're spending it wisely, that you're fiscally responsible, and that you're not really focused on, hey, we just raised it at this valuation. What can we do to drive to get to that next valuation? It's really about driving the business, executing on your business plan, and then the funds will come. So a little bit of a different view, but like that's, what makes the world go round.
Right now, I talk to a bunch of investors, and they all tell me that one of the most overused words that they hear when a new company comes to them is game change. Our product, our service is going to be the next, game changer. Even at the early stage, does it have to be a game changer for you to consider an investment?
Not for us. I mean, I think if they're improving on a product, there's room to take market share from incumbents that aren't doing it as well. Then we're interested. It doesn't have to be a new idea. I think it just has to be better.
What do you think?
Yeah, I mean, I think oftentimes a second or third entrant into a market can learn from the first and second player, and oftentimes you have an advantage from learning from people's mistakes. So it doesn't have to be, it just has to be innovative within a category. It doesn't have to be innovative on its own.
Same with being disruptive. That's another buzzword we hear all the time right now.
Yeah, I mean, if you take one of our investments, Body Armor, which is a sports drink, growing very nicely, they're trying to disrupt the sports drink category. And so that's really disrupting Gatorade, which is owned by Pepsi. And it seems pretty straightforward, but it hasn't been done. So Gatorade's been around since 1960, same shitty formula. And so we're really looking to really disrupt. And that's, on the wellness spectrum, it's healthier for you, so we're targeting moms. So again, old category, but
Yeah.
I think that it really also matters depends on the execution. So my last companies were based in Germany, and Germany is kind of famous of copying the great ideas from the US. But the Germans are actually really good executors. So there's one example of a group that copied Zappos, and their copycat is now probably worth around $15 billion. And when Zappos got acquired, it was like less than $1 billion. So I think timing and execution is also critical. And to your point, you can do something that's already there, you just do it better. I think listening to the consumer, to current market trends, and then executing really well is key.
Let's talk about timing for a minute, since we have so many early stage investors in the room. There comes a point where you have to decide between bootstrapping it and taking investment and deciding how much you're prepared to give up. For everyone, that's different, but where do you draw that line? What's your recommendation to the startups that are out there today that have been considering this debate whether to take on capital or bootstrap? Jay?
I think we're always on the side of the sort of entrepreneur, and it's maybe to a fault, bootstrapping. And even, I was thinking about it with the previous question, with like Robin Burson and what she's doing with functional medicine and Parsley Health and trying to mainstream functional medicine. I think, she has the potential, I think, for a multi-billion-dollar company, but she also realizes that's going to take 8 to 10 years. And from that first business plan 3.5+ years ago, she could probably raise 5x the capital she needs right now, and I don't think she'll do it because she wants to grow it at the pace that's best for the long-term health of the company.
I think it depends where the capital comes from. So if you can find a real strategic partner that can really help with your vision and help execute on your plan, you know, you can get there a lot quicker, and maybe that's the difference between success and failure. So I think it's really a case-by-case, you know, decision, but you know, taking a little capital, again, spending it wisely, but taking capital is never a bad thing, in my opinion.
You know, when I was starting my former real estate company, we had an offer from someone very, very early to invest in the company. And after thinking about it, I turned it down for that reason, actually, because it didn't feel strategic to me. He later got indicted, so it worked out. True story. So, but I want to talk about that. The source of capital is almost as important as the capital itself. You guys could just give your thoughts on that.
Yeah, so I think there's a big difference to your point. I think there's like smart capital or just capital.
Right.
And for example, in my last company, we chose a strategic investor. We said that you are allowed to invest if you bring us this strategic partner that we really wanted, and they happen to own it. And we attached a mandatory deal to their term sheet, and we said, okay, if you sign that deal, we do that, you are allowed to invest. But at the same time, I think it's not just the amount of money that matters. Like what I find, like also in my last company and in ALOHA right now, we have so many amazing, like very experienced entrepreneurs that maybe either just have invested very little money or that I just gave like some shares for free because I really value their advice. And although I started 5 companies, like I don't know many things.
That'd be very good advice, though.
And there are many people around that know many more things. And I think as an entrepreneur, you should always seek advice and bring that on your cap table.
Yeah, I'd also say just know how different types of capital work. You know, an angel versus a family office versus a venture capital fund versus a strategic partner. Some don't follow on invest in later stage rounds as you grow. There's a finite amount of capital. Others want to follow on and do their pro rata as they grow. So just, if you're a founder, do your diligence on the type of capital you take.
Just on Martin's point, I think it's very important. We meet with entrepreneurs all the time who don't know the difference and often get stuck down the line or find the wrong partner or think they're going to support them for years to come, and it's one check and then they want an exit over a certain amount of time. So for entrepreneurs who this isn't their wheelhouse, it's really getting up to speed and really finding who you're getting into bed with, because ultimately it could change the trajectory in a negative way.
Yeah, bad money will kill your business. I mean, your point about the guy who got indicted, do your homework on who the people are and how clean they are, and the right money can blow your business up in a great way, and the wrong money will blow it up in the wrong way.
Talk a little about pitching, because that's what a lot of the folks in the room have been actively doing. First to Constantine, when you are out raising money, talk about what it is, how you message and present to investors, and how you are able to attract investment in the first place. And then from the investment side, what is it that you look for if someone's got 5 minutes to get your attention or 30 seconds to get your attention? What is it that works?
I think this whole entrepreneur thing is like a party. And fundraising is also, starting a company, fundraising is like a party. So what you need to throw a good party, you need amazing people, you need great music, you need some alcohol, you need a nice venue. And that's really about being an entrepreneur and raising money. I mean, first of all, you need to be excited about your party. I mean, if you come like this and say, oh, please give me money, no. You're inviting them to join your party. And you pick those people who join your party because you're the doorman also. And yeah, I think so. You really have to be excited about your own party, and you have to motivate and engage everybody else to be also excited and be go-go dancers for you, and then I think it'll happen.
Now we're talking. Yeah, I know. We're taking numbers on that.
I mean, it's passion. It's basically all the things Constantine described. It's really feeling the passion. Obviously, the business model and the brand have to resonate, but it's really feeling the energy, whether it's across the table or next to you or wherever, that can really get your attention quickly.
What was the question again? I'm still following that nightclub analogy.
My head's still there too, so I forgot. So we're talking about what it is when an investor comes to you, whether they have 5 minutes or 30 seconds. What are the things that you look for that will put it in the pile for consideration, not the pass pile?
You know, I think for me and my partner Tracy Dove, by the way, happy birthday, Tracy. You know, I think we have to really be excited and love the products and be, you know, proud and, you know, and want to talk about them. Another thing for us is how founders report kind of into proactively as part of the due diligence process, like frequent updates on the business. You know, even if you're not, you know, ready to write a check yet, just the ongoing communication in a proactive way from the founders to the capital sources, a way to build a relationship, you know, is really important. And then, you know, we have to have, you know, really motivated founders.
Yeah, I think it's the entrepreneur. I think it's like, what's this, almost the scale of the vision, right? Where do they see the company going? It's what's the vertical look like? How crowded is it? And do they have an angle on it that really seems smart? And a lot of times what we'll do is invest not a huge amount, but we get way more involved strategically. And because of the relationship with ProSieben in Germany, et cetera, the $10 billion media company, as we get closer to a company, we start to see all kinds of places that we can plug in for them.
By the way, for me, like, it's not just about the founder. I think, yes, the business model has to be valid. The margins, everything have to be strong. But to me, the key is the team. For example, if I just sold me, I would not raise any money. I'm a guy with long hair and a weird.
It's a good party though, so I don't know.
Okay, but that's like, you know, like they will still not invest. So they need some credibility also. And that's why having a great team is key, and basically counterbalancing your weaknesses. That's why we have here Molly, for example. We have several rock stars, Jamie. We have several rock stars in our team that just like counterbalance to what a founder is. And I think this will also ease it up.
Piggybacking on that for a minute, I want to talk about failure. I think it was great that the keynote was about that. I mean, when I started my company, it was a disaster. When I tried to write my book at first, I was rejected 23 times before the 24th publisher said maybe and then yes. I mean, we all experience it. And while you talked about there being a lot of money out there, that doesn't mean it's any easier right now than it's been before, too. I mean, it might be more sources of capital out there, but securing that capital is by no means easy.
No, it's not easy, but again, it's also a game here. First of all, never raise money when you need to. You never want to be in a corner, because the first question that an investor will ask, how much cash do you have in the bank? Or like, how badly do you actually need it? So ideally, you don't need it at all. And ideally, you have so many people who want to invest at the same time. And just don't say it. It has to be the case. So don't just talk to one investor, and even if they say, oh, we are extremely interested, the chances that they say no is still 95% for whatever reason. Maybe it's just did another investment, maybe one partner in the team says, no, we don't like this deal, whatever. The chances that they fall out, break out, is like super high. So that's why my advice to you guys who raise money, build like a big pipeline of potential leads. And in order to get the game going, start maybe with those pitching first that are not so important. Perfection at your pitch. And get some ideas, like when they say no, ask them why. Ask them really why, and get to the ground. And if it's business model related, try to fix it. Learn from those no's. I think the no's for me were always really motivating. And then you get better and better and better, and then it happens.
Do you guys track the batting average?
Well, I was just going to say, I think you're really onto something there too, because even if somebody says no to you now, make a really good first impression, because you'll probably be back talking to them a year and a half later, or there may be distribution help. Like there's all kinds of things that you want to come off in the right way to them. And I agree with you also about I used to call it the 3 no's. Like until if somebody says no to you, it's like get to the why they said no, and try and take that one off the table, and then ask them again. And if they say no, get to the why, and like literally make them tell you no 3 separate times, and try and put their concern to bed each time.
I think that's great advice.
Yeah, I mean, I think it's about building a lot of relationships. I also think one thing that hasn't been brought up outside of really strategic investors is an advisory board. So putting together people, whether it's in industry or people that you looked up to, that you can assemble, whether it's quarterly or just people that you can pick up the phone and call, because that can both help from a strategic standpoint, but also when it comes to fundraising, because either they've been in their shoes or they can attach you to their network. So this whole idea of an advisory board, bringing people in, don't be afraid to give them a little equity if it's a meaningful person, and that can open up doors as well.
I'll chime in on that too. Batting average. I'm curious to know like, how many pitches you get versus just a ball.
For me, one to give is adding to your advisory panel. First of all, give advisor shares, but every shares you give, I would put to a vesting to it, because you don't know if they actually really deliver. There's many investment bankers out there, or many people who know other investors, and there's nothing more valuable than a warm introduction, or even better from another entrepreneur. So I found like networking and having true entrepreneur friends and relationships and helping each other is the most valuable, especially when they're successful. And again, like VCs and investors always look for great deals, and they usually come from entrepreneurs.
And I think on just doubling down on the advisory board, it's not just on the capital raising. It's like, look at where you're weak and put people on your advisory board who help strengthen that. Because if you get the right team around you, you can go to that person who's great in distribution, and they're going to have 10 ideas and 5 people that you should go meet with that may be the right person for you to hire, et cetera. So you can really strengthen your team with an advisory board.
While failure is important, there are certain mistakes that should be avoided. What are the mistakes that you constantly see that you think would be good for the startups and entrepreneurs in the room to try to avoid?
I would give an advice: don't be greedy on the right advisors in terms of legal advisors, for example. Like, I always choose the best law firm that has experience in that field where I am in, and they're usually way more expensive, but I think it's worth it. Just use them for fundraising, don't use them for everyday questions, because that might kill you. But there's so many like tricky terms in the term sheet, or like in kind of like liquidation preference. Or what does it mean? You don't care when you raise money now, but you will see when you have a few X's that there is a huge difference if an investor has a 1x or 2x or 3x liquidation preference. So just the terms around that, I think they're super critical. And get the right advisors, don't be cheap.
I'd say don't have unrealistic, huge projections. You don't have to be a unicorn in 5 years to get an investor's attention. You can have slow, steady, sustainable growth. So, just have realistic projections you think you can hit. And if you want to have that aggressive case scenario, have it, and put it in the appendix in the back of your presentation. I'd also say for the founders out there too, there's so much great publicly available free information, podcasts you can really listen to actively and learn. There's one called the 20-Minute VC that's interesting and just talks about founder stories and how they got their venture funding and how difficult that was and how they overcame it.
I mean, I would just to piggyback quickly on that, just on the numbers. Again, if you put out aggressive projections and end up having to pull them back time and time again, if you're having an initial investor come in, that relationship can get off to a little bit of a rocky start. So I agree with that, and also on valuation. Again, taking money in early. You obviously are trying to achieve the highest valuation, but it's also about finding the right partner and giving a little bit on valuation if it's the right partner. It's never a bad thing.
We're going to need to end the conversation now. They're going to start having music play us off the stage. So we're out of time for this segment. We'll continue the conversation with you guys. Thanks so much. We enjoyed it.